Hi everybody, I hope everybody's doing good and everybody's well. We're busy starting again, and the topic of today's theme will be financial planning, income and cash flow forecasting. So that's what we're going to talk today about. Just as an introduction, I will also include a voice message of this whole session that I'm going to do. For if you don't have enough bandwidth to watch the video, you can always just sort of keep the PDFs with you and then just move with me if I talk through the slides. Good guys, so as an introduction, remember we are in construction to make money. That's why we are here. It's a business, and we did deal with the business in the beginning of the year, entrepreneurship. And what we do, the business that we are in, is we are making money by selling construction work, construction or civil engineering work. Now, so what we are doing is we're constructing work, and then we can invoice the work that we get. And then we can make money off that. So that's the idea. So what type of construction are we doing? We're talking about we are constructing a new house, or laying a new pipeline, or building a new road, or whatever we are doing. It is the product that we are selling. So what we do is we invoice the client for the work that we've done. And in engineering, or in the engineering construction work, what we do, because the product that we are selling is so complex, what we are doing is at the end of each month, we are going to the client and say, on a piece of paper, we write down what we've done and what is completed, and we ask them, can you please pay us for the work that we've done? Okay, but it's not that simple, no? Because otherwise I can just say whatever I want to and the client will pay me. So what we call it the payment certificate. So what I do is at the end of each month, I'll write up what I've done on the payment certificate. The client look at that. The client look at the work that we've done, and then the certificate is being approved, and that then becomes the invoice, and on that the client pays us for the work that we've done. Now, so we get paid for the work that we've done every month. Good. So the first aspect that we need to quickly look at is that of profit. So remember, we are in the business of constructing work or making money, and we make money by selling construction work, and we make profit by spending money. So we add value by spending money in our company or in the work that we've done. So what I'm trying to say by this is that in construction, we take raw material, we take people, we take labor, and we take plant, and we make something out of that, which we then sell. So if you then take the cost of those material and equipment and the labor, the people that we've used, if you take the cost of that, we use those resources to add value. So now it's not just loose concrete and people standing and digging a hole and a big compactor anymore. You get a nice road or a nice house or a nice construction work that we've done. So what we've done is, according to the expenses that we have, we've got now something that we can sell, which means we are going to sell it for more than the cost that we paid for those things. So that is what we do. That's the direct cost in the project. But apart from that, remember we are working with a business. No? So apart from the apart from the project expenses that we have on the project, there's also other costs that we need to incur, or that we need to keep in mind when we are costing for these projects. And those are the kinds of costs, we call it the overhead costs. So the overhead costs are the stuff that you have anyway in the company to keep the company up and running. That's your head office, that might be your computers, that might be your HR department, it might be your the cost for your general manager, the people who's not directly involved in the project, and so forth. Now, so the two types of costs that we have is the overhead costs, that's always there, and then we've got the direct costs, that's the cost that increases as you work on the project. Okay, so if we say we want to make money, we need to make money above the project cost, material, equipment, labor, plus the overhead cost that we allocate to the one project. So if we only had one project, then we would allocate the total overhead costs to the company. But because we might be doing a few other projects at the same time, we only allocate a certain amount of money to the project cost that we are busy with. So if you look at the formula there on the slide, it says profit equals your income or your sales. That's the money that you get for the work that you've done, minus the direct project cost, and those are your labor, equipment, and material, minus your overhead costs, and that gives you your profit. That's the amount of money that the company put in their pocket for being in business. Okay, so if you look at the next page, you'll see there's just a very simple project income statement, and an income statement is what we use to show sales and show profit. So you'll see basically we've got the sales at the top, we've got the direct expenses, labor, material, equipment, and plant, and then we've got our overhead costs. So in the example that we have over here, we're going to get 1.8 million rand for the work that we've done. All the direct costs that we have is 1.2 million, 1.275 million, and then we've got overheads of 75,000 rand to also deduct from that, which means the project, the cost, the profit that I'm going to get from this project is going to be 450,000 rand. Good. So that's the one part we're talking about. Now let's talk about the other part, which is cash flow. Now cash flow is something different, is close to profit but not the same. So cash flow is about the physical inflow and outflow of money into our accounts. So remember, if you look at the cash flow income statement, it looks very nice because you've got more income than you've got expenses, which means you have a profitable business or a profitable project. But you're going to see now which are the factors that make that cash flow and income is not the same thing. Okay, so why is it not the same thing? We've got a few factors in there. Number one, in construction, we've got what we call construction guarantees. And what are those? Construction guarantees are money that you have to give to the client. You're not really giving it to the client. You're putting it aside and you commit it to nothing almost. So what you do is you put it in the side and you say to the client, listen, this is my guarantees. I put it aside. So if something happens to me while I'm busy with the contract, maybe my business go bankrupt or there's something big that happened that I can't finish the work, the client still wants to know that the work can be finished. And then they are entitled to that guarantees that you have in place. Normally you put it in you fix it in some sort of a bank or a financial institution, and they also agree that they will keep it safe. You can even get rent on that, and they keep it until the project is complete. If the project is complete, if the project is a success, then they say, construction company, thank you very much. Here's your money back. You can now use that for another project. Now, so you can see that that is cash flowing out of your company. And although you're not even getting anything for this cash, this is just cash you're sitting and putting aside. So it's already shows you that the profit might not be as good as it looks. Then we've got a factor like retention. Now retention is, again, the client, remember the client wants to cover himself. So he wants to say, listen, I know, I trust you, I know that you are good, but something might happen. Now when it comes to the retention, it is actually money that's kept against the quality of the project. So what they say is for every invoice that you give, so every work that you've done, you put an invoice in or a certificate which we spoke about, you put it in, and they say, listen, okay, I know you've earned this amount of money because the work is finished, but I don't know anything about the quality of that work. So remember, we are not selling products that's already made, we are building products. So they're saying, okay, thank you very much for this piece of road. I owe you 2 million rand or maybe 200,000 rand for the work that you've done this month. But wait a minute, I'm not going to give you the 200,000 rand because maybe next week it rains and the whole thing fall apart. So then they say, I'm keeping back, and it depends on what, according to the contract. Let's just say, for example, I'm keeping 20% of the payment back as a retention. And you can get this retention later on if I know you've completed the work and everything is good. Now, some of the retention get paid back directly after the project, and then the other retention get paid back a while after that. So if the client says, oh, it's rained a few times, we're living in the house, everything looks good, you can get that money back. Remember, that's also part of the agreement that you have to have with the client before the project starts. Good. Another factor that we have that sort of indicates that cash flow and income is not the same is the payment period that you get paid by the client. Now remember, your payment is an agreement that you have with the client. So at best case scenario, you do the work on this month, and remember at the end of the month you put in your invoice. There's not a chance by the end of the month, if you put your invoice in right on the last day of the month, that the client will pay on that day. Now, so what they normally say is, we will pay you after the invoice has been approved, maybe 30 days, maybe 60 days, maybe 90 days. You can even have 180 days after the work is done. Hopefully not, because that's really bad for cash flow. Huh? So what that means is that the work that you've done in a certain month, the expenses that you do in a certain month, you are not going to get the money for that in that month. You are at best going to get it 1 month after that. So can you see that it's not the same month? So your profit might look good in the same month, because your profit, your income, you sort of declare your income on the invoice that you send out, not the money that comes in. So it means it looks like you've got the profit, but the money is not in already. And this is sort of where all of this is going. Then the last factor, the last factor that we have is paying your resources. So now remember, you've got material, you've got equipment, you've got labor, and your people are working. Now, okay, maybe something like labor, you don't want to keep the people, you don't want to keep people, pay them too late now, or that won't be fair. Let's say you work for a construction company and they say, yeah, they will only pay you in the next month for the work that you've done this month. So that doesn't make sense or is fair. So some of the stuff is that you paid, like labor, you paid straight away, the month in which the work is done. But other stuff like the material, you might have a nice agreement with your material company or the hardware shop who says, okay, it's fine, we know you well, don't worry, you can pay me after 30 days or 60 days or 90 days. And the same with your plant, maybe your rental or whatever you have in there. So can you see again that your income is not even always declared on the same month that you've done the work. Your income is, but not the money flowing in. And also with the money flowing out. So that's a few factors you must keep in mind. So what does it all mean? It means that we might not make the profit on the project, but we might make profit, but we don't have enough money to take on the project. And you guys are going to see in the example that we're going to do as an extra video to this. Okay. So the process, just in quickly, we'll see that sort of the fourth last slide that I have over there, is first you set up an income statement. So you'll have a look at the total project. You see, am I going to make money? Then you look at the monthly income statement. So you break up your project into months and see how am my income going to realize over time. And remember, your first cutoff is always income. Now, if you don't make money on a job, don't take it on. So that's a nice indication of that. But then you say, okay, wait, it looks like I'm going to get good money off this project, but wait a minute, can I actually afford the project? And that's where your cash flow statement comes in. So you'll see the last step is setting up a cash flow statement, and then there's a few questions you actually can answer out of that. So before going to the video, I'm just going to quickly show you this as well, the last sort of example, the first of the example slides. So we will always give you some information. We'll give you the project duration. We'll give you the construction security, how much the security is. We'll tell you what the retention is. And also there's always a maximum retention. So they don't say it's 10% of the project up to, whatever the project size is. They always say 10% of the total project, but up to 100,000 or 200,000 or 300,000. You're going to see how we're going to use that in the examples. Then we've got the payment certificate. When are we paid after the payment certificate? We also say how much profit the company wants to make, the contracting company. We say we'll give you the retention, when the retention is paid back, when, how much and when. Then we break up how your contractor's direct costs is broken down into. And you'll see that's sort of labor, material, equipment, how much of your direct cost is sort of linked between those, as well as when you have to pay them, 1 month afterwards, 2 months afterwards, or directly. Then we say how the contractor is allocating the overhead cost, how much. In this case, it's 15,000. And then we'll give you sort of a schedule of predicted payments or certificate schedule that we're going to get. So each month in the project, how much you predict to invoice, that's what it is, and also the total. And then I'll give you the instructions which you'll need to do. Good. So have a look at these slides, listen to the video, listen to the voice recording, and then I'm going to do a nice example or a video example of example that you can get from these stuff.